I invested in index funds for 10 years and lost money. That's what some unlucky investors might say after what's called a lost decade. A whole 10 years where your real returns after inflation go negative. It's a big worry for a lot of people. You put in all this time and cash expecting growth, retirement, and financial freedom, only to end up with less buying power than you started with. So I got curious and dug into 96 years of data to find out how often this happens and how you can protect yourself against one. I'm considering a lost decade as any 10-year stretch where your actual returns, your real returns after inflation, dip below 0%. The reason is because who gives a rip about a positive return if inflation is outpacing it? If you made 5%, but inflation was 6%, you're still losing. You can't buy as many bananas as you could 10 years ago, which my bowl of Cheerios isn't going to be too happy about. I'm also not counting a 0% real return as lost either. No, your money didn't grow in this case, which isn't ideal, but you didn't lose any buying power either. It's like parking cash in a savings account that is way too lazy to move. Sure, some growth would have been nice, but it's not a total bust since you're not out anything. Where I started was wanting to see how many lost decades pop up when you stick with something like a total US stock fund, with just pure stock moves and nothing more. I picked this over an S&P 500 fund because I was curious if tossing in small and mid-cap companies would shake things up. So I looked at every decade since 1929 in fixed 10-year blocks, starting fresh each time. Turns out, an investor would have stumbled into 3 lost decades, starting in 1930, 1970, and 2000. In the 1930s, we have the Great Depression, which stocks tank, and good luck buying that brand new iPhone. Then in the 1970s, it was inflation city. No bananas in your Cheerios for this whole decade. Finally, in 2000, we've got the dot-com crash, then the financial crisis kicks you in the balls while you're down. 3 flops in 96 years. Not a total train wreck, but you're probably drinking frozen orange juice instead of fresh squeezed for a few 10-year periods. Here's the catch though. This isn't real life. Nobody is out here dropping a chunk of cash into the market on January 1st and just chilling for 10 years to see what happens. You and me, we're putting money in every single month. Real investors don't play by these neat little decade rules. This all-in at the start trick is a sketchy way to guess how many lost decades people like us would actually hit. To avoid the questionable invest one time and wait for 10 years method, I went for something closer to reality for this next test. What if we stopped pretending we dump in a chunk of cash one time and just wait? Instead, we're putting money into the same total US stock fund every month, like a paycheck contribution no matter what. So I checked every rolling 10-year stretch since 1929, not just those tidy decade blocks that don't overlap. Here's what I dug up. Lost decades jumped from 3 to 7 in 96 years. Starting in 1966, 67, 68, 69, 70, 73, and 1999. The 60s and 70s were absolutely brutal because stocks flopped like a fish at a frat party and inflation gobbles up your cash like it's free taco night. Starting in 1999, the tech bubble began to burst and you are still digging out of it by 2009. Here's where we still have the opportunity to change some things up about our portfolio to see if we can reduce the number of lost decades below that number 7. Even though something like a total US stock fund doesn't pay out a large amount in dividends, we'd still want to assume that we're reinvesting them as time goes on during the accumulation phase of investing. So let's roll with that for this next scenario. I wanted to test taking those dividends from our total US stock fund where we're already tossing cash in every single month and use them to snag up some more shares. Here's what I found. Lost decades dropped from 7 in our previous example to 2. Just 1969 and 1970. This was mainly due to the fact that returns could not outpace inflation. Now don't get the wrong idea by thinking dividends are some Indiana Jones holy grail, like you should only chase high dividend funds to dodge those lost decades. That's a trap. High dividend funds can tank just as hard when the market crashes, and their payouts don't always save you. In the 1970s, some big dividend names still got hammered alongside everything else. The real trick isn't the dividend size, it is the total returns. price growth plus dividends. When times are good, stock prices can skyrocket like in the 80s or 90s, and you're missing that if you're only focusing on payouts through dividends. The problem is we can't predict when these boom times hit or when they will fizzle. So banking on dividends alone is like betting on half the game. I think we all got to admit that on a rolling basis, 2 lost decades in 96 years is pretty darn solid. But I'm wondering, what if the US is stuck in the mud for those lost decades while the rest of the world is crushing it? Could adding a total international stock fund reduce that from 2 to 0? Okay, let's keep everything we've got going on so far. Monthly contributions into our total US stock fund, reinvesting dividends, but now let's add an international ex-US fund to globally diversify. I went with 70% total US stock fund, 30% international stock fund allocation as a starting point to see what would happen. Lost decades creep up from 2 to 3, 1968, 69, and 70. That 70s inflation mess wasn't just a US problem, it was a whole world problem. As you can see, the returns were a minor loss, but based on our rule of anything less than a 0% return, they're considered a lost decade. Now here's what I found interesting. We're always told global diversification is God's gift to man, like a cheat code to investing. But in this case, it backfired. That 30% international didn't save us. In fact, it seemed to make things much worse. 3 lost decades isn't terrible, but jumping from 2 feels like a step backwards. So I got curious, of course. What if we lean harder into the international side and bump up that allocation? Could we flip it back to 2 lost decades or even less than 2? As with the last example, we're going to keep everything the exact same except tweak the international holdings just a little bit until we find one that moves the needle. So instead of the 70-30 US international allocation that we just went through, let's start with a 60-40 allocation. Turns out this is what gets us back down to 2 lost decades, 1968 and 1969. Once again, the losses aren't a bloodbath, but they're still negative. I even tested a 50-50 allocation and it was still 2 lost decades. So it seems as though a 60-40 split was the sweet spot. All of you who invest in a total world ETF with this exact allocation like Vanguard's VT can take your victory lap now. Here's the tricky thing about a potential lost decade. You can't be sure that you're in one until you're deep into it or it's already over. It might feel like everything is dragging for years, but only hindsight reveals if it truly was a lost decade or just a long slump. Kind of like my life. If you're in the accumulation phase though, this uncertainty can be a huge hidden opportunity. So here's how to make the most of it. To ride the wave of eventual market recovery, you have to keep buying when the markets aren't moving or even falling. I know that it's tempting to hoard cash and wait for the next boom, but when prices feel stuck and nothing seems to be happening, that is when discipline really starts to matter. By steadily investing during these quiet or tough times, you're snapping up more shares at lower prices. When the market finally bounces back, those consistent purchases can compound into serious wealth. I'm not sure if anyone noticed, but we just went through one of those down periods. I was looking at the S&P 500 chart, and from the end of December 2021, it dropped and didn't climb back to those same levels until around the end of December 2023. A slow market like the one I just showed you can lure you into pausing, lowering contributions, or even worse, trying to time the bottom. And my friends, that is a recipe for regret. Instead, automate as much as possible. That way, every time money hits your bank account, it's sent to your investment account. From there, money in those accounts automatically gets distributed to the investments without you having to touch anything. This is one of the many reasons M1 Finance is my preferred investing platform. You set an allocation across all of your holdings, then it automatically distributes money to each one based on that allocation. I'll have a link to check them out in the description down below. This keeps emotions out of the equation so you are not second guessing yourself during that downturn. Once it's automated, tune out the daily market noise, set it, forget it, and please let time work its magic. Keeping costs low is always crucial, but in a flat or down market, high fees can be an even bigger silent killer. If your returns are already barely breaking even and your fund charges 0.25% plus, or even worse, your advisor skims 1%, you're costing yourself even more money. In a low growth environment, every percentage-based fee matters. Always opt for low-cost index funds or ETFs and question any fees. By minimizing expenses, you protect your wealth from a self-inflicted lost decade. A lost decade in one market like US stocks doesn't mean the whole world is stuck. Spreading your investments across global markets increases your odds of capturing growth somewhere. It's easy to overlook this when everything is booming, but a globally diversified portfolio isn't about chasing the highest returns in every bull market. It's about delivering solid returns when markets are up and not the worst returns when they're down. Long-term diversification is the best way to make sure you're covered no matter what type of market we're in. All of the lost decade data that we looked at in the beginning of this video is based on the past and what would have worked back then. But history is not a crystal ball. The future could unfold so much differently. But keep in mind, it's not about predicting what's next, it's about positioning yourself to make it no matter what happens. By staying disciplined, keeping costs low, and spreading your bets out, you're ready for whatever the market throws your way. In some cases, there is nothing you can do to avoid a lost decade, and that's okay. The good news is that if you're going through it, everyone probably is as well. Stay employed, make sure you understand how to manage and track your money, keep saving, and stick to your plan. A lost decade might slow your progress, but it won't derail you if you stay focused. Keep adding to your investments because even in the tough times, you're building a foundation for the recovery. When markets turn, and they always have, you'll be in a position to capture the growth, not just survive the slump. I'll have a link in the description to check out Bolden, the retirement planning software I use to model scenarios like lost decades to see their impact on my financial future. It gives you a clear picture of how your investments, savings, and withdrawal strategies hold up so you can plan with confidence. Hit that like button before you go. Done. I invested in index funds for 10 years and lost money. And my mom grounded me because of it. She said, "Jarrad, you're a fucking idiot."